Have you ever wondered what invisible hand nudges interest rates up or down, impacting everything from your mortgage to business loans? It is a powerful force, often operating behind the scenes, yet its effects are felt throughout our financial lives. Open market operations, or OMO, directly influence interest rates in the economy by altering the supply of money and credit within the banking system. Simply put, when the central bank conducts OMO, it changes how much money banks have available to lend, which directly affects the cost of borrowing. The core mechanism behind OMO involves the buying and selling of government securities, primarily United States Treasury bonds, by the central bank. When the central bank purchases these securities from commercial banks, it injects new reserves into the banking system. With more reserves, banks have an increased capacity to lend to each other in the overnight federal funds market. This increased supply of reserves drives down the federal funds rate, which is the target rate set by the central bank. Conversely, when the central bank sells government securities, it removes reserves from the banking system, reducing the supply of funds and pushing the federal funds rate upward. This federal funds rate then serves as a crucial benchmark for other interest rates across the economy. So, how does this ripple through your daily financial life? A change in the federal funds rate translates into shifts in other key interest rates. For instance, if the federal funds rate decreases due to OMO, banks typically lower their prime lending rate, which is the rate they charge their most creditworthy customers. This reduction can then lead to lower interest rates on variable rate mortgages, car loans, and business lines of credit, making borrowing more affordable for consumers and businesses alike. An increase in the federal funds rate would have the opposite effect, making borrowing more expensive. This intricate process is part of what economists refer to as the monetary policy transmission mechanism. OMO represents the central bank's primary tool for managing liquidity in the financial system. It allows the central bank to guide the economy by making borrowing cheaper or more expensive, thus influencing spending and investment decisions throughout the nation. It is a precise and flexible instrument, enabling gradual adjustments rather than abrupt shifts, which is essential for economic stability. Understanding open market operations reveals the central bank's powerful role in shaping economic conditions. By subtly adjusting the availability of money in the banking system, the central bank influences the cost of borrowing, which in turn impacts economic activity. This process helps steer the economy toward goals like full employment and price stability, ultimately benefiting everyone through a more predictable and healthy financial environment.